Hello and welcome, dear dividend investors. Once more, it's my second video of the day on this English channel, which is rather rare. So, first video was 3M versus Johnson & Johnson, and the next one, someone asked in this post in the group Dividend Growth Investing if I can make a similar comparison between large defense stocks, Lockheed Martin, L3Harris, Raytheon Technologies and General Dynamics. I said I could do so if his request gets at least 10 thumbs up within the next 24 hours. This was 3 hours ago and he already got 11 thumbs up. So it's up to me now to make this video. So let's go and we enter the screen on and I remove my screen capture here, so you can see anything we have to offer. Yeah, I already created this watch list here at TOC, and then we have all these 4 stocks. We apply a better suited ranking, which will be dividend income once more, because if I look at the dividend yield here, it's somewhere between 2 and 4.5%. So that's already a decent dividend yield, and I think this corresponds to a dividend income strategy. These stocks are from the United States, all dividend payers, paying all quarterly dividends, market capitalization rather large, between 110 billion and around 40 billion US dollar here. And we are not going into the detail from the ranking. We will see the most important facts, I think, very soon. So regarding dividend yield, where do we start? We start from the highest dividend yield to the lowest, because this might be what you would do. Higher dividend yield is more interesting to many people. So this is Raytheon Technologies, and then here we see we have a problem. We have a problem regarding they posted losses within the last 4 quarters. The earnings per share is exactly $0, and the estimate for the current business year is 40-cent losses. And there is on parallel a dividend cut ongoing. Dividends $330 will fall to 185, so about half. Here we see it, the estimates dividends will be halved. That's not a good thing. The dividend yield 4.5% here is based on the last 12 months. What does it mean? It means we can see it here that we go back here. This is 1 month. This one bar corresponds to 1 month. And we collect the last 4 dividends of the last 12 months here. And then we get 4.5% based on today's stock price. But the dividend cut is still ongoing. You see it here. Oh, so many managers here in parallel. I think I should close Teams right now. Goodbye, colleagues. And then the dividend yield will be lower, 3.2%, and then there will be a restart, and maybe dividends will increase from this point. But it's a bad thing, and I think for many of you won't buy the stock now after this dividend cut occurred, because our companies do better. If we look here, Raytheon Technologies, by the way, it was a good dividend stock so far, I think. Let's go back here. If you see this here, I will make it larger. I will enlarge it here. You see that they increased dividends for a very long time. I can't say you the reason why things are going so badly right here, but they were a very reliable dividend payer, and you still see here the dividend stability. The dividend stability is calculated based on the last 20 years, so starting from here to there. So estimates are not yet taken into account, and we have a year 1 this starting dividend cut, which means that overall, if you look at that, if you calculate the correlation between time from 20 to 2020 and the increase of the dividends, then we still have a solid dividend payer. But this right now breaks the nice history. And let's go to General Dynamics, how things look there. And here you see the picture is much smoother and more investor friendly. So in 2012 they had a problem, but they didn't cut the dividends. So now I get a call. I must say someone that I'm just busy doing a video maybe. I'm not cutting anything because this will be a quick and dirty video. So okay, they didn't cut the dividends, and I think that's a much better picture. And they also have higher dividend stability. They increased the dividends for 29 years already and didn't decrease for 32 years. Let's jump to Lockheed Martin. Lockheed Martin looks even better because they posted losses in 2000. So the loss business year gets farther and farther away into the past, and they also have 3 awards. They also even have an award for as earnings rocket, which means that they grow their earnings more dynamically than all other 3 stocks. And their dividend yield is 2.5%. And then we have L3Harris Technologies, and here is a little problem. That's a fundamental problem because analysis is more difficult due to the merger. You can see that there was a merger because revenues artificially go up. So compared from their business year ends in June, and you see that the first time all the merged revenues were reported was in 2019, and now in the business year which just ended 2020. But if we look at the dividends, then we also see that we have here a very reliable dividend payer. Dividends increase here. The dividends of L3Harris Technology increase even more dynamically than the dividends for General Dynamics and Lockheed Martin, which increase a high double digit or nearly 10%. We can make here this use the dividend benchmark to give you an idea about the evolution of the dividend yield. We start with L3Harris Technologies, because they have the lowest dividend but the highest dynamic. It's always interesting to do so. Here you see dynamic dividend increase, and this is your personal dividend yield. Right now, if you buy the stock, 1.9%, and then your personal dividend increases. That's calculated by a rhythm, and this is calculated, not calculated, but taken from the analysts. And now let's take the other ones to give you this comparison. Raytheon Technologies, General Dynamics, and Lockheed Martin. And here they are. So, and what you can see here is that Raytheon Technologies is very unsafe what will happen about their dividends. So the algorithm says there's no dividend growth. You can't determine dividend growth, which means that dividends remain low or sluggish. But we have dividend increase here for General Dynamics and Lockheed Martin. And we have even more dynamic dividend increase for L3Harris, the blue area here. And L3Harris will, the dividend increase will double the dividends of the other companies in 2034. So this is just a guess, but it shows you a possible way. Okay, what is also important is this earnings stability, because you know that dividends can only be paid out if earnings increase, cash flows increase, and so on. And this is where General Dynamics and Lockheed Martin shine, while Raytheon Technologies has some problems there, especially based on earnings. There's even a warning sign. L3Harris Technologies, we must be careful about it due to the merger. The metrics are not so bad. +1 is the best, but we really have General Dynamics and Lockheed Martin. They are really outstanding compared to the others regarding the predictability of both earnings, and this is operating cash flow. So these are maybe the safest bets of all four right now. And then we have the valuation here, and if you look at the valuation, then we see that General Dynamics from this point of view, it's based on the fundamentals of the last 4 quarters compared to today's stock price. Then here we have 4 different fair value metrics based on different metrics, like here earnings, reported earnings, adjusted earnings, operating cash flow, and dividends, and all 4 fair values indicate an undervaluation here. That's why I'm clicking here, because I'm interested in this baby. There's the valuation, and once more we see the fundamentals here. We see that the positive loss in 2012, we see the stock price, we see that the stock price went up. Okay, it went down starting from 2018 spring, but overall it went up. And if we invested in General Dynamics starting at the end of 2000, then we got an annual yield of 8.3%. I think that's somewhere in line with the performance of the S&P 500. And now let's check out if the stock is over or undervalued. I'm just taking the whole period here to calculate the different multiples, and based on these average multiples we get fair values. Here they are, and I get rid of the reported earnings. You see here we have outliers, that's the year they posted losses, and we prefer the adjusted earnings here. And then we have this operating cash flow, the fair value based on the operating cash flow, and it's also a little bit bumpy. I get rid of that one. And then we still have 2 fair values, and I think we take these. As usual, we have phases or periods of overvaluation followed by periods of undervaluation of the stock, overvaluation. Then we met the fair value war again in 2016, and then one more period of overvaluation. This blue line is the fair value based on dividends, and you see that it's a very, very solid dividend payer, General Dynamics. And what might be even more interesting is that the stock looks undervalued right now. I just show you that based on the other fair values, there's the same result. So based on the last 4 quarters, the stock is fairly valued somewhere between $160 and this won't really change if we take the current business year. So let's get rid of these once more. Based on the dividends, the stock is even heavily undervalued. It should be $250. That's the fair value. That's because the current dividend yield is much higher than the dividend yield of the past. You can see it here. This is the current dividend yield and the dividend yield of the past. That's the current dividend yield. And you only achieve higher dividend yield during some months, financial crisis included. Now let's go back there. And what's interesting is that the analysts estimate that adjusted earnings will go up, which means that the fair value of the stock will also go up. And if we look here and now we can calculate our estimated yield, and then we get an annual yield of 18%. So it's much higher than the long-term annual yield you made with General Dynamics, but it looks plausible to me, at least, because if I think here the stock was more or less fairly valued, or say it in another way, the stock simply looks undervalued, and if it reaches his fair value and the stock market or the stock price goes up, then your yield, your annual yield will go up as well, of course. You can also, oh no, I didn't want to do that. We can also, like here, we can also calculate our estimated yield a little bit more careful by selecting here this 176 US dollar as our estimated stock price in 2023, and then the annual yield, dividends included, is still close to 11%. So to me, I don't own the stock, but it rather looks attractive. Lockheed Martin, this is the other stock which shines with very stable profit growth and operating cash flow growth as well. So let's check out the valuation and what to expect from this stock in the long run. And here we are. We just add all our fair value metrics, and then once more operating cash flow is still a little bit bumpy. Let's get rid of this one. And here we see that there's no big difference between reported and adjusted earnings, which means they did not post, at least not till starting from 2002. They had no how to say, I'm just missing the right word in English. They had no write-offs, for example, some things like this, some extraordinary items which decreased the reported earnings. Okay, then we have here, this is logarithmic. Then we have here phase of fair valuation, undervaluation, fair valuation, more or less. Then the stock became overvalued here, especially in the end of 2017, start of 2018. Then it became fairly valued once more. This is the Corona crash here, though the stock was very attractively valued. And now the stock is more or less fairly valued with a very slight overvaluation. Current stock price is 387 US dollar. Fair values are close to 400 US dollar. So it's slight overvaluation. And then let's check out the long-term yield with this stock, if it's higher than for General Dynamics, and yes it is, 14.5%. So in the long run Lockheed Martin performed better. By the way, we should also see it here, for sure. You can also see it here that in the long run Lockheed Martin performed the best. And then we have L3Harris here. It's interesting, but here you must really be careful because of the merger followed by General Dynamics and Raytheon Technologies. The red lantern here. So I think Raytheon Technologies is not in the race anymore. I think these two stocks, General Dynamics and Lockheed Martin, will do. They are the best choices to me right now. And now what to expect, which overall yield. So if we just go there and make it here once more, one more click. And here we might expect annual yield of 10.9%. So that's less than for General Dynamic. When I was connecting the dots with the fair value, which was calculated for 23, which is not surprising because General Dynamics seem to be undervalued and this stock isn't. It's fairly slightly overvalued. And if we calculate our estimated yield a little bit more carefully and go here, then we have an annual yield of 7.2%. And I think for General Dynamics, it was about 10 or close to 11%, if I remember well. So I think that's it. So to conclude, I don't have any of these stocks. Don't buy the stock and blame me guilty if something's not going as you wanted it to go. But General Dynamics and Lockheed Martin, they look the most promising. And if I had to opt for a stock for long-term investing, I choose Lockheed Martin. For short-term capital gains, maybe I'd prefer General Dynamics. Okay, the video is over. Thanks for watching. I hope you liked it. Bye bye. See you next time.